Hey guys, good morning. Today is Wednesday, June 26, 2013. Todd is still out of the office. He'll be back on the 5th of July on Friday. So in the meantime, I'm going to step in for him and just go over a few things. Just looking back at our trades that we talked about yesterday on Occidental Petroleum. Seeing here, if you went long automatically yesterday, you actually got a better price right in here, right on the 38 of the day. Otherwise, if you waited, it did put in an inside bar, so if you ended up getting long, you could have gotten long on the open. The market's just pulling back in here, okay? But now, you've got a relatively tight stop on this, okay? And remember, like we talked about yesterday, you can use that ATR, okay? We're at $1.83, so if you split that in half, what is it, 92 cents or so? So you'd want to go 92 cents below this low here, okay? So if you get the low right around 87.60, you're looking at 86.70 for your stop, okay, at this point. So you got a relatively tight stop on the trade right around 86.70, okay? So if you're long, you're looking at 86.70, okay, for the stop, and then your first target. What you can do, you can either do the math, or what I like to do is I just draw the fibs up on there from your long entry price, and if you took it off the 38, your target is going to be right around this 92.15 level. So you'd be looking to take profits off at right in here at the 50% mark at 92.15, and a second target. Normally I'd go halfway between the first target and the high, but you've got some profit target trippers in here. You got some institutional actually selling activity in here. This is where the market kind of topped out, so you might want to just go ahead and bring that down a little bit. That second profit target inside there, okay. And then let's look at Intel. Intel was the other trade we were looking at. Here's Intel here. Same thing. If you got long, very similar trades in here. If you got long off of the inside bar in here today, you may have traded it off the open or waited for it to pull back in here, and you could either be long in there, or if you got long yesterday, you would have been getting long right around in there. In either case, you got a relatively tight stop. Now let's look at the range on this. We've got 52 cents, okay? So 26 cents below this pivot low here, okay? So this looks like right around, let's see here. The low of this bar is 23.41, so 21, so 15, so 23.15. 23.15 is your stop on that trade. 23.15 is your stop on this trade if you're long in here, and then 50% will go off the 38. Right at 50% is 24.89, so 24.90 would be your first target. Okay, first target would be 24.90, just right in there. And then the second target, nothing wrong with going ahead and going halfway back up to the high of the day, or to high of the swing here. So market's just pulling back today. We'll see if we get continuation, maybe later today or tomorrow, to the upside here, and look for that first target to get hit. If not, we've got our stop down in here. Relatively, real tight stop now. Low risk trade in here. Okay, very low risk. We're talking 2 or 3 to 1, at least maybe 2.5 to 1 ratio, reward to risk. Okay, so and I wanted to go over a few other things, just some ideas, guys. If you wanted to, there's another way. For swing trading, you can use this daily chart. Okay, if you are able to manage the trades throughout the day, if you can check the charts every hour or so. Let's say if you're doing something that provides the opportunity for you to access your computer, access your charts every hour. It's just something to think about. If you wanted faster swing trades, where you're actually risking less, depending on, it's all relative. This would be for smaller, with folks with smaller amount of capital to trade with. You can look to trade the options on these different instruments. But one of the things that I learned was looking at the 60-minute chart for swing trading. And what you're doing is you apply the same principles that, you apply the same principles in your trading plan. You just apply it off the 60-minute chart. Okay? So like in this situation, you would actually be looking for a short setup in here, on a pullback in here. But you can apply the same principles that on the daily chart to the 60-minute chart. It's just faster trades. So like a daily chart, for example, may keep you in a trade anywhere from 3 to 5, maybe 7 days. I mean, sometimes up to 10 days or so. The 60-minute chart, you could still swing trade. Sometimes you're in it just 1, 2, 3, 4 days. For those quicker, hit and run type, more like a hit and run type methodology without actually day trading. And then you can actually manage the trades a little bit tighter. So, for example, let's just look at a few charts here. Let's look at, let's look at like ExxonMobil, for example, and Caterpillar. We've got some opportunities in here. As this market's breaking down through here, you apply the same principles that you did off the daily. Once we broke down through this low, you're drawing your fibs up on there, and you're looking to potentially take an entry somewhere in here. And if you're able to get short in here, your targets were hit. And look, you'd be getting short in here at the end of the day. You've got your stop up in this area. We could draw the fibs up on there. I don't know how to get this. Every time I do that, it wipes out the notes. But you have your stop in here above the 62% fibs, above the moving averages, counter bands, and then you'd be getting in at the end of the day. And sometimes you get those gap downs, and your target gets hit below your like if you're short, you actually get a better fill on your target, because sometimes the market gaps down, it fills you right at the open with a better price, and you actually make more money that way. But just something to think about in here. You can see you can apply the same principles, guys. You've got another pullback in here. This one, you may have just been whipsawed on that. But low risk, we're only talking, in this case, if you're going to trade ExxonMobil, the range in here off the 60-minute chart is right around 60 cents, versus on the daily chart, looking at almost twice as much volatility because of the range. So that's just something to think about. If you wanted to trade, let me find one here, like Schlumberger. There's your daily chart. Let's go to a 60-minute chart. And what I suggest, again, is, you trade a percentage of your capital and then determine which time frame to trade off of. So here's another example of, I meant to go over this yesterday but ran out of time, of using the ATR to help you define which time frame to trade off of. So, figure out how much capital you've got, how much percentage, 2%, 3%, how much you're willing to risk per trade, and then potentially, you've got to figure out how much position you're going to take and all that. 100 shares, 200 shares, one option contract, 2 or 3 option contracts, and then look at the average to range and see if that individual market, if the daily chart on that individual market is just too much, you're risking too much, you can potentially scale down to like a 60-minute chart, if you're working all day, and your orders are based on end of day, then obviously, you've got to be able to manage it off that 1 hour chart. So if you're going to trade off the 60-minute chart, you're going to have to be able to manage it every hour or so. Just check it. I mean, sometimes you're not moving your stop for a couple hours, but I mean, here's a great example where the market, changed trend to the downside, market pulls back right into a potential, right into resistance, and getting short in here, all profit objectives. Getting short, in here, back in resistance in here, all profit objectives, were eventually hit. Now here was an example of, you could have been looking to get short right on the open on this day. Got your stop sitting right there. Took a little heat. Nothing. I mean, this is just normal. You got a bearish outside or double 3 minute double bar high with a lower low, lower close. At this point, you could jam your stop down a little bit, go half an ATR above the high of this bar, and then on the next day, you got your condition order, or you got your order in there that says, hey, you know what? If we penetrate down through this level, exit a portion of the trade, and then so forth. And you can see in here, you entered in the morning. On the next day, you actually take off a portion, and then on the third day in the trade, you're out with 2/3, and a couple days later, well, actually, on the next day, so here's a 4-day trade. You're out with the remainder of the trade in here, unless you implement a trailing stop, then you're probably getting out about 7-8 days later. So just keep that in mind. Something to think about if you wanted to. The 60-minute chart is great. For a little bit quicker trades, the 30-minute chart is great. I mean, you can even look at a 78-minute chart. So that equally divides the time in 5 equal intervals throughout the day from 9:30 to 4 o'clock, so Eastern time. So hope that helps, guys, and we'll see you tomorrow morning. Have a good day.